as you all know by now, I am passionate about helping you improve your overall financial health and helping you build your confidence and knowledge when it comes to making smart money decisions. The thing is, it all starts with the basics, and what I mean is the budgeting basics. The wealthy have the basics down when it comes to budgeting, and I really want to help you take that next step to building your own wealth. It's time for you to take the information you hear in my podcast and take action. So I created an online, simple to follow, and easy to understand course with all of the tools and resources you need to be successful. You're going to learn things like understanding your why, setting smart financial goals, calculating your net worth, diagnosing your spending patterns, how to tackle debt fast, creating multiple streams of income, and you're even going to learn how to calculate exactly how much money you need to be financially free. So make sure that you check out my budgeting basics course at www.achieveyourmoneygoals.com. You will be happy you did. Welcome to episode 45 of the Financially Free Journey podcast, and I am your host, Courtney Dyer. Well, welcome back, everybody, to the Financially Free Journey podcast, where we aim to dispel the seemingly complex topic of personal finances, money management, debt, savings, investing, and even retirement. And in today's episode, we are going to be covering how to choose the best investments for you. Now, this episode's topic was chosen after a listener wrote into me and they sent an email, which my email is financiallyfreejourneypodcast@gmail.com. But the email that was sent posed the following question. Hi, Courtney. I would really appreciate if you would cover how to go about picking the best investments for yourself individually. I've been doing a lot of research and understand some of the basics, but I feel like I just can't grasp if the options that I think are right for me are actually right for me. I'm terrified of picking the wrong investments and messing up. Please explain. So this is such a great question, and it's also a pretty common predicament that many of us find ourselves in. It can be human nature to tend to really overanalyze. And have you ever heard of the saying paralysis by analysis? Well, this is where you think about and you research something so much, and then you have so many options to choose from that you just end up not making a choice or any movement at all. This is a predicament that we find ourselves in throughout many different facets of our lives, and especially when it comes to making decisions and changes with our money. Now, making the right investment decision is an important choice to make, and you should absolutely not do it without being informed and making the decision with all of the information you need to make the best decision for you. The issue here is that a lot of people don't know what they should be researching or where to find that information. So in this episode, I'm going to break down some things that you need to really consider and make sure that you understand about investing prior to making your investment decisions. Now, for most of us, we are investing for big goals, like retirement, for example. And these big goals that you're saving and investing for are too important to jump into as an ill-informed investor. It's important to take the time to research your options and decide what's important to you. But it's also equally as important to take action on the information once you gather it. So before becoming an investor that's going the DIY route, there are some pretty important questions that you need to ask yourself to understand your investment style. So let's go over a list of different investment styles and strategies to really help you determine your investment style and how to pick the best investments for you. So here's the first question that you need to ask yourself and consider prior to anything else. Are you a quote unquote do-it-yourself investor, or should you consider hiring a professional financial advisor to invest your money for you? Now, to put it plainly, whether you decide to do it yourself or have a professional advisor do the investing for you, you are choosing an advisor. I want you to think about it this way. If your family or your friends came to you and asked you for a recommendation on a financial advisor, would you recommend yourself? Do you want to hire you as the advisor to manage and invest your money, or do you need to hire someone else to do it for you? What is the value of your time compared to the cost associated with hiring an advisor? I want you to also consider this. Do you enjoy the process of researching different companies to invest in? Do you enjoy looking through company financials and analyzing things like a stock's PE ratio? Do you enjoy more basic money things just like budgeting or saving? If the answer is yes, then fantastic. You could do a great job at investing your funds and making the right decisions for your investment style. Now, if the answer to these questions was no, then I would highly recommend that you look into hiring a professional financial advisor to manage your investments for you. Now, regardless of whether you do the physical investing yourself or you decide to hire someone else to do it, it's still important for you to really understand your investment style so you can have an informed conversation with your advisor and understand what's being done with your money that you've worked so hard to earn. So let's go over a basic principle of investing, which is passive versus active investing styles. You may have heard of the term index funds, and you might not fully understand what that means, which is okay. You also may have heard of the term day trader, and you really don't know exactly what that entails. So let's go over these two opposing investment styles, and let's just see where you lie exactly. Now, if you believe that the extra time, energy, and trading costs that are required to actively trade is not worth it, you are most likely what's considered a passive investor. Passive investors are looking for more sustainable, long-term growth in their investments, and they believe that really over time, the stock market rises, and if you are adequately diversified, then you're really going to see the compounded growth and capital gains on your investments. Now, if you believe that by doing research, understanding financials, and actively being involved in the investments that you make, you're going to be more than likely an active investor. This means that you believe that you can outperform the market as a whole and capitalize on buy-sell opportunities if you pick the correct stocks. Now, this is also referred to as strategic or tactical investment styles. Now, a strategic investor believes that the idea of outperforming the market is foolish. And if you just buy and hold your investments over time, you will see returns. A tactical investor believes that if you really do your research, you can outperform the market with well-timed moves to achieve returns that are superior to the market as a whole. Now, if you have uncovered that you're a strategic or a tactical investor based off of what I just described, let's cover the idea of buying stocks versus mutual funds and really which one is best suited for you. Now, as an investor, you can buy individual stocks of companies, or you can buy into what's called a mutual fund, which is like a basket of stocks with a lot of different companies in it. The question a lot of the time is which one of these options is best for you. If you are an average investor, a novice, or a beginner, looking into the option of mutual funds is most likely going to be best suited for you. Studies have found that stocks that individuals buy underperform after they buy them and then outperform after they sell them. This is primarily due to the fact that over 75% of all traders are institutions, which is some pretty steep competition. Okay, we are going to take a quick sponsor break, but when we come back, we're going to continue to discover what type of investor you are, so don't go anywhere. Okay, I am so excited to share this episode's sponsor with you, WYLD Gallery. Now, WYLD is an Austin, Texas-based gallery that exclusively features spellbinding, original, one-of-a-kind Native American imagery that really explores heritage, culture, and tradition. WYLD carries a variety of art, including oil on canvas, acrylic, prints, and even posters. Several of the artists featured at the gallery have paintings in the permanent collections of museums like the Smithsonian and the American Indian Museum in Washington, D.C. and New York City. And I went on and I checked out the art, and I am honestly blown away. I found a piece called The Black Sun that is to die for. It is a beautiful pop of color that would look beautiful in my home. And what I love is that WYLD carries art for every budget. And what a great gift for the holidays to give your loved ones a one-of-a-kind museum quality piece of art. The art is honestly mesmerizing, and I highly recommend that you go check out the website at www.wyld.gallery to start shopping for beautiful one-of-a-kind art today. Now, another aspect that is attributable to this is the concept of investing into a stock based off of investor sentiment. So here's an example. You are sitting around the dinner table with your family, and your brother-in-law mentions that he just made a ton of money on a certain stock and that you have to look into it. So you go home, you buy the stock, only to see that you don't get the returns that your brother-in-law was bragging about. Well, why is this? Most individual investors tend to buy stocks when the stocks are popular, and that means that they are high when it comes to the price of the stock because there's more trading going on. The more a stock is traded, the higher it drives the price of the stock. Now, once you see that you're not getting the returns that your brother-in-law was talking about, you dump the stock after the value of the stock went down because you really want to cut your losses. This is another example of buying and selling stock based off of investor sentiment and emotion. Most individual investors buy stock when it's overvalued in price, and then they sell the stock when they start to see that they're taking a loss. This is why most people who try to jump into the market and buy individual stocks fail to see positive returns overall in their investment portfolio. Now, this brings me to the next investing styles that you really want to consider and determine which style you are as an investor. So let's talk about value investing versus growth investing. What's the difference and why the heck does that matter? A value investor is someone who is looking for stocks selling at a quote unquote discount. A value investor is looking for a really good deal when it comes to the purchase price of the stock. It's like going bargain hunting at the store. You're going to buy things when they're on sale, right? Value investors look for stocks that are selling at a price that is low in relation to the earnings of the company that it has on the books. A great way to get exposure to value stocks is by buying into a mutual fund that has a value objective. Now, the value objective is built into the investment strategy. And so the stocks that the fund manager picks is going to be value stocks in the fund. So rather than spending countless hours researching companies and reviewing their financials, you can look into a mutual fund that has a value objective so that you know all of the stocks that your money is going to be invested into is aligned with your personal investment beliefs. Okay, now let's cover growth investing. As the name states, growth stocks typically perform best in what's called the mature stages of the business cycle, which is when the economy is growing at a steady pace. The growth strategy reflects what corporations, consumers, and investors are all doing at the same time in a healthy, growing economy, which is gaining increasingly higher expectations of future growth and spending their money to do it. Now, a great example of a growth stock is a tech company. This shows you how a growth investor believes that the tech company is a great pick, even though the stock is typically overvalued. That just means that the price of the stock is high in comparison to the actual earnings or worth of the company. This is because the investor believes that the company or the sector that the company is in this example, tech, has tremendous growth potential. Now that we've covered value versus growth investing strategies, let's quickly touch on what the term buy and hold means. I think I mentioned that earlier, and I just want to dig a little deeper so you feel comfortable with that term. Buy and hold investors believe time in the market is more prudent investing than timing the market. The strategy is where you buy investment securities and then you hold them for long periods of time. This is because the investor believes that long-term returns can be reasonable despite the volatility of the market in the short term. This strategy is the complete opposite strategy of market timing, which typically has an investor buying and selling over shorter periods of time with the intention of buying at low prices and then selling again at high prices. Now, if you've heard the term day trader, as I mentioned earlier, this is exactly what this is, and that's what it's describing is day trading, that short-term buy and sell. And this is the complete opposite of the strategy of buying and holding. Now, the buy and hold investor will argue that holding for longer periods requires less frequent trading than other strategies. This also means that trading costs are minimized, which is also going to increase that overall net return of your investment portfolio. Okay, so we've covered a lot. We have talked about a few things that you really need to understand, and it will help you when it comes time for you to really determine what type of investor you are. And it's really going to help you pick the best investments for you. So here are some questions just to wrap this up nicely. Number one, are you a do-it-yourself type of investor, and do you want to be actively involved? Now, if the answer is yes, you will be managing your own portfolio, and if the answer is no, then you're probably going to be looking into hiring a professional to manage your investments. The next question is, what theory do your beliefs most align with? Do you agree more with the value investing theory, or do you more align with the growth investing theory? Next question is, do you think it's possible to time the market, or do you think that time in the market is more important? How do you feel about diversifying your portfolio by investing in hundreds of companies through a mutual fund or an index fund? Would you rather take a chance on investing large sums into individual companies? These last two questions will really help you nail down if you would rather invest in index and mutual funds rather than picking individual stocks or companies to invest in. And the last question I want you to really think about is, how do you feel about market volatility? If you woke up in the morning and your account value dropped by 50%, how would that make you feel? This question will also help you better understand what type of investor you are, really depending on the amount of risk you're willing to take with your money. You have to make sure that you have an answer to these questions and you're able to really adequately define what type of investor you are prior to meeting with a professional. Now, you don't have to know perfectly and really be able to articulate, growth or strategy, tactical, but I want you to have an idea so you feel confident with the basic fundamentals of how the market works. There is a lot more that goes into understanding what type of an investor you are and how to pick the best investments for you. But I am going to dedicate additional episodes to this topic so that way we can really continue to dive deeper into this topic and you can really understand the fundamentals of the market. But for now, I want to finish up this episode by thanking you for tuning in. And if you haven't already, make sure that you go and subscribe to the show, rate the show by tapping on the stars, and then just take 30 seconds to write a review. I am excited to announce that I'm actually going to be giving away free lifetime access to my online course to 3 different individuals that take the time to write a review for the show. Now, I have never given away free access before, but I think with the holiday season, this is just a great time to run a giveaway for my course. And it's really just that gift that keeps on giving. So this is how it's going to work. Because reviews help the show become more discoverable to the podcast community, and therefore it really helps more people discover the show and hear this content that could potentially change their life. So starting today, I am recording this episode. It is December 18th. I am going to any review that is written from today, the 18th, until December 24th is going to be entered into the giveaway. So this is how it's going to work. Here's what you need to do exactly. Go write a review on Apple Podcasts. You just go to the show, so search in Financially Free Journey, scroll down until you see where it says ratings and reviews in purple, and then you're going to see the words write a review. Just click on that and write a quick review for the show. Make sure you tell us what topics you like to hear or what you would like to hear, as well as why you're listening to the show. That's going to be so helpful to make sure in the coming new year that we're really fine-tuning the content and the episodes to what you all want to hear. So after you leave a review, just send me a quick email to financiallyfreejourneypodcast@gmail.com and let me know that you left a review. And this will officially enter you into the drawing to win free lifetime access to my online course. I am going to announce the 3 winners on December 25th on the Christmas episode, and I will also send you an email to confirm that you've won. How amazing would it be if you woke up on Christmas morning to find out that you've won access to the course for free? And if you win, you actually get to decide if you want to keep the access to the course for yourself or if you would like to gift it to a loved one. So when you win, I'm going to email you and ask you some information to activate the access to the course, which will be like your email address. And you can either choose at that time to give me your email address, or if you want to gift it to someone, give me their email address, and I will activate the access to the course for the email that you choose. So I hope you guys are all excited about this giveaway. I am so pumped. I think the holiday season is just a perfect time. And also, we are starting a new year. So to help you or your loved one meet their financial goals and objectives. So make sure that you take the 30 seconds. It is going to be well worth your time. So again, thanks for tuning into today's episode. And if you're not already, also make sure that you're following us on Instagram. It's at Financially Free Journey. You're going to get more tips and motivation to help you on your financially free journey. Until next time. Hey, before you go, have you checked out my online course yet? If you want to eliminate debt, build up income, and know how much money you need exactly to retire, make sure you head over to www.achieveyourmoneygoals.com to take action today.